So are the inflation fears worse than imagined? Are more rate hikes likely? Will inflation control kill growth in the months ahead? Is India heading for a period of stagflation as some experts fear? Today we will bring you four top economic voices to tell us what lies ahead. Sunil Sinha is Senior Director Public Finance and Principal Economist India Ratings and Research. Madhvi Arora is Lead Economist MK Global Financial Services. Prasenjit Basu, Head Economist at ICICI Securities, and Sachidanand Shukla, Chief Economist, Mahindra and Mahindra. Madhvi, why don't I start with you? Give us your sense. How bad could it get? Is this a little too late, as some are saying? The RBI should have moved in much earlier? Or do you believe that, in a sense, the RBI is recognizing that we are faced with a serious inflation crisis and was calibrating its move?
So I think it's the latter, as far as I understand. So essentially, the kind of pivot that we see from the RBI's end, essentially emanates from the fact that, the kind of inflation print that we are seeing in the next 1 or 2 months, or the one that we saw a month ago, was something that RBI probably was not pricing in. And the realization is that inflation is probably here to stay. The kind of forecast that they were working with for the whole year, which was sub 6%, is now going to be challenged substantially. And just to put things into perspective, if the RBI misses their inflation targeting a range of 6% for 3 consecutive quarters, they are answerable to the government of India as to why they weren't able to contain inflation. Because in the end, inflation tends to impinge much more on growth than what one really thinks about. So I think to some extent it was a late realization, and it was more of a catch-up versus what is happening in the rest of the world, and the realization that the supply constraints are here to stay, which means that given the current demand that we have in the economy, the supply would definitely be much short in supply, and thus you could probably see a much more wider mismatch between demand and supply, and inflation will essentially accentuate further from here on, unless of course controlled by the monetary policy side of the economy.
Will, you mentioned world economies, and let me take that at the moment to you, Prasenjit Basu, a Head Economist at ICICI Securities. The fear is, when I look at the numbers, is that we could argue this is global inflation, it's not India specific. United States 8.5%, highest since 1981. Eurozone 7.5% lifetime high. United Kingdom 7%, highest since 1992. Germany 7.4%, highest since 81. Turkey 70%, highest since 2002. Sri Lanka in the neighborhood, complete mess, 30%, highest since 1948. Should we look at, therefore, the glass as relatively half full, that we are better off than some countries, or the fact that we too need to get out of this mood of denial that we've been in for several months now, that things will get better?
Look, in India, inflation of 6% or slightly above 6% isn't that unusual. If you look at the last 40 years, we've often had inflation of above 6%. In fact, from 2009 to 2013, inflation was consistently above 10%. So we are used to this higher inflation rate. In the US, to have inflation above 2% is unusual, and they are at 8.5%. So it is a serious problem in the rest of the world, perhaps less of a problem for us, relatively speaking. Now, I think the important point to understand, though, is that Europe is about to shoot itself in the foot by banning all crude oil imports from Russia within the next month and a half or so. Now, if they were to do that, it would probably cause a recession in Europe in the second half of the year. But in the short term, it would result in an even higher oil price for the rest of the world, because 11% of world exports of crude oil come from Russia. If Europe, which takes 48% of those exports, bans all imports of Russian oil, then it's going to be very negative for world oil prices. Now, in addition to that, we've had a ban by Indonesia on crude palm oil and refined palm oil exports, which basically means the largest exporter of palm oil in the world has decided not to allow any further exports from their country, at least for some time. That has pushed palm oil prices to an all-time high. And we'd seen that cooking oil prices were moving upward. Now, this Indonesian action has made it worse. So
are you saying, Prasenjit, it will get worse before it gets better? Are you saying, particularly given what's happening in Europe and in the neighborhood, it could get worse before it gets better? Prices could go up further. We could be back to 2009, 8-10%?
Well, I don't think we'll be back to 8-10% inflation, because the RBI has started taking preemptive action now. Also, it's important to understand that monetary growth in India is actually pretty moderate. Right through this period, this COVID period, average broad money growth in India was only 11% compared to a 15.4% average for the last 30 years. So we actually had lower monetary growth during this COVID period than India had in the previous 30 years. That's a sharp contrast to the US. Right. If you look at 60 years of monetary growth in the US, average for the US is about 6.8%. During the COVID period, it was nearly 19% for the US. So the US had extraordinary monetary accommodation, which they are now having to roll back. India didn't actually do that. And so our inflation rate is picking up because of oil, because we are a big importer of oil. And of course, oil prices are pushing upward, and they're going to push upward over the next 6 weeks, I think, in particular, right, because of the likely action by the European Union. And so what we've basically got is a commodity inflationary spiral, which does, of course, affect us because we are significant importers of crude oil. But interestingly, from the external payment standpoint, we have very strong export growth of petroleum products. Refined petroleum products are soaring even faster. So from an external payment standpoint, we're in pretty good shape. But inflation is going to be a problem. And that is why the RBI had to take this action between meetings. It's 5 weeks ahead of its next scheduled MPC meeting. The RBI had to intervene and raise rates. Remember, there will be those gone back.
Sure, but there will be those who
to where they were in May 2020.
Sure, there will be those, of course, who will argue that maybe the RBI should have acted earlier. Was there political pressure on them? Remember, there was an election period between November and February. I'll come back to that in a moment. But Sachidanand Shukla, Chief Economist at Mahindra & Mahindra, your sense, there are economists who are now writing about the potential concern over stagflation, that we are heading into a period where we could be in a stagflation spiral. Is that a fear that you have?
So, Rajdeep, if you look at what's been happening globally, probably stagflation is a risk in Europe, in US probably. In India, I think with growth being at around 7% and the RBI having preemptively reacted to the inflation prints, and our numbers suggest that the April numbers might be anywhere close to, say, 7.5%, 7.7%. I don't really think that stagflation is a risk for the Indian economy as we speak. But indeed, it is a big risk elsewhere in the world, especially the developed economies. Now, the problem with this, Rajdeep, is that inflation is the emperor of all economic maladies. And given the kind of economy we are, a large informal sector, a large, say, bottom of the pyramid population, low income levels, for example, for a bulk of the population, inflation does hurt disproportionately, and it eats into the purchasing power, and therefore, I think it is imperative that the RBI actually look at the inflation prints and inflation really getting out of hand. I think that is a serious challenge. And I think another very important factor, Rajdeep, is that we don't live in an isolated sort of a world. We are interlinked with the rest of the world. And there has been a quit India movement by the FIIs. If you look at the last 3-4 months, FIIs have sold close to about $20 billion, and that's massive selling. Now, mind you, from September onwards, the US Fed is likely to also withdraw liquidity to the tune of $90 billion a month. And US dollars are going to be at a premium. And at this juncture, when your inflation prints start going up, and in interest rate differential actually narrows vis-a-vis US, we were at a serious risk of much stronger outflows from the Indian economy, and that brings us back to that same old spiral, as you know.
Right.
Indian economy looks very different with oil above $100 and risk off. So I think it was about time that the RBI recognized the fears and the worries of inflation getting out of hand and getting much more entrenched, and therefore they had to really react preemptively. I mean, some people would argue that they could have done it before.
You know, let me throw again what some experts are suggesting, Sunil Sinha. Some are saying scope for taming inflation, taxes on pump prices of petrol and diesel need to be lowered to ease price pressure. Agricultural policies need adjustments to ensure that food prices do not rise too high. We need a fiscal policy also to insulate the economy from a demand shock that is likely to take place at this critical juncture. Do you see potential areas where inflation could be tamed? The RBI has acted. What do you see the government doing?
Well, Rajdeep, it is easier said than done. I mean, of course, there are many issues which we are confronting with at the current juncture. As you rightly put it, I mean, the global commodity prices are on the higher side. Inflation is inching up. The purchasing power is going down. Even agricultural commodity prices are on the rise. So food inflation is also staring at us. So all of these issues are definitely there. So it's a difficult situation. There are no easy answers. But yes, even within this kind of atmosphere or environment, something can certainly be done. And one of the way to look at this whole issue is that if we look at the tax buoyancy over the last fiscal as well as even in the current fiscal, the tax collection have been fairly buoyant. So at least from a tax collection point of view, the government need not worry as much as it used to in earlier times, when typically the overall tax collection used to fall short of the budgeted estimate. And here we are in a situation where the chances are that the overall collection will be higher. So at least there is a room available for the government to look at the tax rates which are imposed on the oil, petrol and diesel, so that some kind of comfort or some kind of leeway is given to the economy in general and households in particular. So that certainly is something that government should and can look at.
So you're giving a potential solution, at least a temporary solution. Look at tax rates for petroleum products at the moment. It seems unlikely whether the government will bite the bullet on that. So I'm going to go right round once again to ask each of you for sharp, short comments on the one solution that you have. The RBI has acted. What would you like to see now governments do? Madhvi Arora, you start. What is that one thing you'd like to see the government do?
I think the policymakers anyway have been proactive with regard to food price management. They already have just taken away, I think an hour ago there was a flash which was saying that the edible oils duties have also been cut. So I think to some extent the government is going to bear the brunt of cutting excise both on petrol and other edible oil. But that again will somewhere impinge their fiscal numbers and again impinge on their ability to spend, especially on the rural sector. But I think from the policymakers' point, since it is a supply shock and it's external shock, as everybody's been talking about, there's little that you can do with regard to managing it, except for probably, giving some tax relief here and there. But again, it will also impinge on your overall fiscal picture, which essentially will again come back from one form or the other in the form of inflation, be it supply side or demand side. So I don't think it is that easily said than done. You can bear the brunt by not passing it on to the consumer to some extent. But even as an economic agent, government is also going to bear the burden of it, which will again, in some way or the other, via a wider fiscal deficit, will come back in the form of inflation. So it's not a very easy answer to say when the inflationary shock is not domestically driven.
Right. Let me go again. As I said, very short comments because I've got limited time. Prasenjit Basu, what is that one thing you'd like to see happen now? What can give the consumer a sense of relief at this moment?
Well, I think it's important for the government to ensure that the fiscal deficit continues to come down. If the fiscal deficit comes down, as it will, given the buoyancy of revenues, then eventually you will see a decline in the whole structure of interest rates. So I think that there isn't a need for the government to always do something. We've got a response from the RBI, which is appropriate. The fiscal position is improving. We are seeing very strong revenue growth. The government has cut the excise duty at the end of October. There's scope for a little further cut, but it's not essential. I think it's more important to ensure that the fiscal deficit declines. And if the fiscal deficit declines, you will automatically get a crowding in of private investment. And there is no fear of stagflation in India. I can assure you that India is now the world's fastest growing economy. Last year, calendar year growth was 8.3%. India's exports have been the fastest growing in the world for the last 16 months. So there is no danger of any form of stagflation. You know, even in the last month, we had almost 25% growth year on year in exports in dollar terms. So that is a lot faster than China. It's much faster than Vietnam, Korea. Most other countries are looking in some awe at the strength of our economy, and it is currently export-led. What is required, of course, is that the exports need to be complemented with a pickup in domestic demand, and that can only happen if the fiscal deficit continues to moderate and allows private investment to be crowded in. And that is what will happen if the government just stays on the sidelines, allows the revenue.
I'm sorry, I've just got a minute left. That's why very quickly, Sachidanand Shukla, to take off from what was said just now by Prasenjit Basu, that how is consumer demand going to pick up in an environment at the moment where with interest rates high, there's a sense of people at the moment concerned over inflation. So where is consumer demand going to pick up now?
So Rajdeep, if you are trying to raise interest rates aggressively, as the RBI has done, and it will continue to follow through with the rate hikes going forward till they achieve that neutral rate, I think the onus is now going to be squarely on fiscal policy. I think one area that I can probably argue for is doubling down on infrastructure spending as was promised in the budget. And that is not going to be inflationary. That will put some money into pockets in hands that really need it by way of construction jobs, by way of informal jobs. And I think another very important factor related to fiscal policy, Rajdeep, is that the government needs to not only front load spending, but it also needs to remove the volatility in spending. So what has happened over the year and a half is that the government spending has been very, very volatile. And that induces a lot of uncertainty into households and businesses. And the last thing you want from the government is to induce another uncertainty in this environment, which already is very, very volatile. So I would argue for front loading of spending, doubling down on infrastructure spending, and removing the volatility, ironing out that very, very volatile spacing out of the expenditure. So I think that could probably help putting some money into pockets. But definitely, Rajdeep, when you're trying to raise rates and be aggressive, there is going to be an element of sacrifice in India. That sacrifice ratio has been found out to be close to 2 to 2.8. For example, for every unit of inflation that you want to bring down, you might have to sacrifice 2 to 2.8% growth. Back to you.
Okay. I have run completely out of time. I wish we had more time, but we will expand this in a roundtable one of these days. This remains the critical issue in a way of our times. But I appreciate all of you joining me here on the news today. Thanks very much for giving us a sense of what lies ahead. These are difficult times, but tough times lead to tough people. Thank you very much for joining me.